Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures are searching for direction after the Dow closed at a new record on Tuesday. Earnings are driving the action, and while we're still early in reporting season, so far the results coming in strong. According to LSEG, 87% of the reports so far have beaten expectations. And it's already been a busy morning. Some of the top movers to watch on their earnings reports: AT&T, GE Vernova, and Hilton. We're also keeping an eye on the precious metals market. Gold is extending declines after seeing its worst one-day performance in over a decade. Plus, Netflix shares are sliding ahead of the opening bell. The streaming giant's third-quarter earnings were hurt by a tax dispute in Brazil, and revenue came in just shy of expectations. Now, the company is seeing growth in its advertising business. It says it's on track to more than double ad revenue this year. And the big report Wall Street is waiting on tonight: Tesla. The electric vehicle maker said to report amid threats to the future of the business, especially the expiration of the EV tax credit. Tesla reported record deliveries in the third quarter as buyers rushed in before the tax credit deadline on September 30th. Analysts will also be watching for a hit from the elimination of sales of regulatory credits, which has helped support revenue for years. Let's get a check-in now on stock futures. As we said, not much change here. Is kind of searching for direction, but the Dow continues to push higher by a bit here this morning, so we'll see if it extends its records. The S&P 500 also getting a very small lift, and the Nasdaq trading slightly lower, indicating that way for the open. Let's dig into our top stories of the day now. Netflix earnings missing estimates, disappointing investors. Precious metals continue to sell off, with gold having its worst day in a decade yesterday, and Tesla earnings on deck with CEO Elon Musk's potential pay package in focus. Joining me now, Yahoo Finance senior reporter Allie Canal, senior markets reporter Ines Ferre, and Brian Moody, Kelley Blue Book executive editor. Thank you all for being here. Allie, I want to dive right in with Netflix with you, because that really is having a significant effect on the shares and also just, causing some investor jitters here this morning.
Yeah, and we're seeing shares extend those declines in early pre-market trading today. I'm looking at shares down another 8%. Now, I will say, heading into this report, expectations were high. The stock is trading at around 45 times forward earnings. Heading into the print, we were up over 40% since the start of the year. So investors wanted to see a little bit more, and unfortunately, we did get that miss on both revenue and earnings. Now, the company basically tying this to an unexpected tax expense in Brazil, which also cut into operating margins for the quarter. Netflix did say, looking ahead, they don't expect that tax expense snafu to materially affect earnings in the future. So that's one thing. And they did strike a more upbeat tone, guiding to stronger than expected results in the current quarter and reaffirming that full year revenue guidance at the high end of its prior range. And then the advertising tier just continues to be a bright spot here. Both executives and analysts have pointed to Netflix's ad tier as really the next wave of growth for this company, especially as it focuses on generating more top line momentum and acceleration there. The company is expected to more than double its ad revenue in 2025. That's helped by a few partnerships. Netflix recently partnered with Amazon for a new DSP integration that expands how marketers can buy ad inventory directly on the platform. We also saw the company strike a deal with Spotify to bring video podcasts to Netflix. So that's expected to help both with subscriptions along with that ad tier. And then meanwhile, the company is saying engagement remains really strong and healthy. And that was helped and boosted by a few content wins in the quarter, including a successful boxing match. We also had K-pop Demon Hunters become the most watched film ever on Netflix. And I was speaking with our Yahoo Finance anchor, Josh Lipton, about this. He says with a 6-year-old, this movie is on repeat. So just goes to show how Netflix can take relatively unknown IP and make it into hits, successful, bingeable content. And just digging through some of the analyst commentary this morning, Julie, a lot of bullishness still. Despite these misses, despite the stock decline today, a lot of analysts on Wall Street really advocating to buy the dip.
And Allie, of course, the other thing that's going on, not directly with Netflix, but in this business, is the Warner Brothers Discovery news we got yesterday that it is indeed thinking about a sale of either all or part of the business. Netflix, it had been floated as one of the potential bidders. Did we get any kind of color on that?
Yes, and they were asked about this on the call. It was no surprise considering what we heard from WBD, basically assessing its breakup options. The companies that have been rumored to be interested include Netflix, along with Comcast and Paramount. But Netflix basically said it wasn't totally interested. I want to play a little bit about what co-CEO Ted Sarandos had to say on the call.
It's true that historically we've been more builders than buyers. And we think we have plenty of runway for growth without fundamentally changing that playbook. Nothing is a must-have for us to meet the goals that we have for the business. We've been very clear in the past that we have no interest in owning legacy media networks, so there's no change there. But in general, we believe that we can be and we will be choosy.
So no interest in owning legacy networks, but it could be interested in Warner Brothers Discovery's IP. So that's something that we'll have to wait and see as we get more clarity on these potential deals. Warner Brothers Discovery, I think, would want to sell the whole company, but it could definitely sell in parts as well. And Netflix also going on to add that they have a lot of runway to grow organically through technology, through generative AI. They did talk a bit about Gen AI and the opportunities there when it comes to customer retention. Along with the content side of the business, it's already been playing with how to utilize Gen AI to make content easier and also cheaper ultimately. So a lot to really look ahead to when it comes to Netflix. But again, investors are a bit disappointed. Shares are off around 8%.
Yes, indeed they are. What is also off this morning, precious metals. Ines, you've been watching this trade very closely, which was very strong for much of this year, and now is taking either a breather or more of a dramatic interruption. I don't know.
Yes, and this could be the start of a correction, which would be 10% or more off its high. Right now, gold is off about 8% off of its high. UBS saying that they believe that this sharp move to the downside was mostly technical. There's no real macro or geopolitical reason for this to happen. They believe that it had a technical component to it. I mean, you have had Wall Street strategists talking about how it's an overstretched, overbought commodity because you saw the run up on gold. I mean, at the height of the rally, gold was up about 60% year to date. Right now, it's still up 50% year to date. And so this move that we saw to the downside was more looking like an unwind of a momentum trade. You've had some terms being thrown out like the cryptification of gold just because of the massive rally that we saw in gold. Now, the question is whether we will see more of a drop. Now, Bloomberg has some data out that's going back to 1990 that shows that with big moves like this, it usually doesn't necessarily stop here. So the big level to look at is the $4,000 level. If the gold breaks below that, then you could see it going even lower. Now, the question, though, Julie, is whether this move in gold would translate into equities as well. And the data shows that gold, the market cap is at 5 trillion versus 60 trillion for equities. So it doesn't necessarily mean that you will see sort of any type of downward move in equities or a correction because of gold moving to the downside, but certainly a sharp move for the precious metals in general.
Yeah, and it's been so interesting to see gold and stocks go up at the same time, which is relatively unusual and sort of implies maybe some hedging going on. But we'll see indeed how that, if there's any kind of feedback loop or commentary around what it means for equities. Ines. And then, Brian, we got to get to you because we're, of course, eagerly awaiting the Tesla numbers after the close of trading. It looks like that investors and analysts on average are looking for, sort of modest gains here. What are you going to be focusing on?
Yeah, the modest gains will likely come as we see those taxpayer-funded EV credits expiring, so people who wanted an electric car would rush to go get that in September. I'm guessing that you could see a drop-off in October, but at the same time, we sold plenty of Teslas before there was incentives, and my guess is plenty of people will buy them after. I think growth for revenue with Tesla might not be just selling more cars, although they do have their new Model Y standard model, which is a less expensive Tesla. That's probably going to get some people interested. But I think growth in the robo-taxi and robo-van, those areas are probably where investors will be looking for growth with regard to Tesla. It doesn't seem like just sell more electric cars is going to be a strategy going forward, especially given how many competitors we see and how many electric cars we see, the models specifically, just being canceled. So could that help Tesla in the long run? Probably, but the rules almost never seem to apply to Tesla. The customers love them for the reasons they love them, and it's not always obvious to the rest of us why that is.
A couple of follow-up questions here, Brian. The hit that Tesla took earlier this year, which was a political hit, how sustained does it look like that is?
It doesn't look like that's sustained at all, because most people, that was a temporary thing. It happened for such a short period of time, people barely would have time to turn in their leased cars. It's not like this is a long-term thing.
Well, but is it a long-term depressor of demand if the brand reputation and perception has changed?
It's possible, but the hard thing with that is that Tesla has been so dominant before, and now all of a sudden there's, high quality competitors. How can we know for sure that it's the brand that's been tarnished versus just a ton of excellent competitors? So it's hard to know where that market share erosion is coming from, but that's definitely coming for Tesla.
And in your view, what are the most formidable competitors at this point? Either, say right now, and then a year from now, what's coming down the pike that's also going to be competition?
Right. So I would look at cars like, believe it or not, the Nissan Leaf, which is an affordable all-electric vehicle with a great range, and they have a variety of ranges. So that's one thing. The interior is well laid out. Many consumers are saying that they don't necessarily want everything going through one touchscreen. So looking for cars down the line coming from Audi is a great competitor for Tesla. BMW has some excellent high-end electric vehicles. And also Porsche, I would consider to be a Tesla competitor based on the way they drive.
Really interesting stuff. Looking forward to not just the numbers today, but what we're going to hear for the next year from Tesla and those competitors. Allie, Ines, Brian, thank you so much.
Thank you.
Coming up on Morning Brief, the meme stock frenzy. It's back again. We'll look at the names moving and how to trade it. Time for some of today's trending tickers. We are watching AT&T, Texas Instruments, and Beyond Meat. First up, AT&T adding more mobile phone and home internet subscribers than analysts expected. AT&T won 405,000 new mobile phone customers in the third quarter. It's gained ground with the new customer guarantee introduced in January. That offering promises better network reliability and customer service. Next is Texas Instruments giving a lackluster forecast in its latest earnings report. The biggest maker of analog chips said the overall semiconductor market recovery is continuing, though at a slower pace than prior upturns. Texas Instruments CEO said industrial customers are taking a wait-and-see approach to their factory expansions. And finally, Beyond Meat, the plant-based food company, along with other so-called meme stocks, is surging yet again. That takes the company's four-day gains to 1,300%, 1,300%. Now, let's put all this in context. About 64% of Beyond Meat's available shares for trading had been sold short as of the end of September. 64% is an extraordinarily high number. So the recent rally in the stock may have investors covering their shorts, then that adds to gains. Also rising, other stocks, many of them with high short interest as well. Krispy Kreme on the list, 1-800-Flowers. They've attracted meme traders as of late as well. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, that meme stock frenzy, it's back on Wall Street. Shares of Beyond Meat, as we just mentioned, rising 1,300% over a four-day period. Our next guest says fundamentals still matter for investors. Joining us now, Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager. Matt, good to see you. So we've been noticing the renaissance of the meme stock trade, which, it doesn't entirely go away. It has lots of these little bursts of activity. But given as it comes during a bigger discussion about bubbles and what we're seeing in the market in terms of speculation, how are you reading this latest outbreak?
Well, good morning, Julie. Thanks for having me back. Yeah, I think this is a throwback to 2021, the hope, dreams, themes, and memes kind of environment that we were navigating in that time frame. And just to kind of give you some aggregate numbers in terms of how this market has been behaving since the April lows, it's really been led by these types of opportunities, or in my opinion, risks in the market, where companies that don't have any positive earnings, maybe they're losing money, really leading markets higher. Over the last 12 months, the S&P 500 technology sector, one of the brightest spots in the market's up 25%. But if you just look at technology companies that are losing money, that performance total has almost tripled that 25% number, almost over 70% returns. So it is a speculative kind of risk that's starting to build up in markets. And for your viewers out there, I would say that this isn't a very kind of normal market environment for these types of companies. Typically, you'll see these big spikes, but then on the other side, there are risks to the downside.
And Matt, I'm curious, when you're looking for investments, do you have a hard and fast rule? It has to make money, or what kind of screen are you putting on in these cases?
That's a really good question. I think there needs to be, over our forecast horizon over the next 3 to 5 years, a ability for the company to out earn its cost of capital. And so they could have businesses that haven't yet reached critical mass, that are not yet earning money, but the unit economics of the business are really strong, and that once they hit that scale, and you have to have conviction that they'll hit it, lead to really strong financial returns for shareholders. Maybe some of these companies do fit that profile, but in aggregate, you'll see through history that it doesn't tend to work out that way.
And so when you're looking at many of these meme stocks, which don't necessarily have that 3 to 5 year time horizon of out earning the cost of capital, or maybe it's possible, but we don't know what that game plan is. I mean, do you think that investors are making a mistake, or are some of them just kind of trading these things, and so they're not necessarily viewing it as a buy and hold fundamental investment?
Well, I think that's certainly an important distinction. If you're trading it, that's different than investing in it for a longer term time frame. But one factor that I think probably is a useful tool in a lot of investors' portfolios is the importance of price momentum or fundamental momentum as an input to their investment process. A lot of these companies do have price momentum behind them over the last 12 months, over the last 6 months, been very, very strong. But I think for this to persist into the future, these companies also need to demonstrate fundamental momentum. Okay, growing revenues, growing earnings, consistently out earning their cost of capital, for this to not only just be a trade, but turn into a sustainable investment.
And so, Matt, let's broaden this out, because there are certainly other areas of the market that have been speculative besides the memes. There's a lot of talk that the largest companies in the stock market could be in a bubble. I'm talking about the Mag 7 and the concerns over AI. So sort of extrapolate what we're just talking about, but talk about these big stocks and whether you think that they've gotten out ahead of their skis.
Well, we're talking about a very different quality profile. Let's just first, underline that point. Companies that are in the Magnificent Seven, so companies like Google, Microsoft, Apple, as an example, far out earn their cost of capital sustainably, and they do it consistently. Now, a lot of the fundamental momentum behind these names the last few years has been driven by the AI compute infrastructure build out. The sustainability of that, I think, is the question mark. So far this year, we've seen continued upward revisions as we look to 2026. If you look at the 4 largest hyperscalers, estimates for 2026, CapEx have risen by over 40%. That's a significant number. Over another $100 billion worth of CapEx is expected for 2026, on top of the $300 billion that was penciled in at the beginning of the year. And so that is investment that's going to flow to the NVIDIAs of the world, the Broadcoms of the world. It's just the question of ultimately the return on investment of all of this investment. And so certainly these companies have the cash flows to continue to spend. It's just whether or not they're going to continue to spend from their point of view of seeing that return on that investment. And it's just simply too early to tell at this point.
So if it's too early to tell, do you just kind of buy them all and wait? Or, what strategically do you do?
I think you diversify it. But if you're an investor in it today, I think you continue to hold it, because number one, these companies are extremely profitable. Number two, revisions are moving up. That's a very important factor as it relates to kind of stock performance. And then number three, I think that if AI does turn out to be this huge productivity enhancer in the future, these investments might ultimately translate into being very lucrative investments. And so, to me, I think it's more of a hold in terms of if it's in your portfolio already. But in terms of continuing to press and concentrate in this space, we think it makes sense to diversify some of that exposure as well.
Matt, thanks a lot for joining us. Appreciate it. Coming up on Yahoo Finance, opening bid with our executive editor, Brian Sazzi. Saz, what's coming up?
Julie, what do you think about that Beyond Meat move? Wow, I came into the office today, sat at my desk, stock was up 135% pre-market. So we're going to dive more into Beyond Meat. Loved your explanation of it, digging into that short selling data. That, in fact, is our stock of the day. Question of the day, I'm going to deep tease it. AI may be sending up all of our electricity bills, Julie. I'm not happy about it. Not happy about it.
Yeah, I don't think anybody is happy about it, Saz. And I also saw a story this morning that we're not going to close the energy gap with AI, the need for AI for our lifetimes. So.
Yeah. Well, I mean, look, Julie, I have no lifetime. I will be living till 500 years old, so I could see all these trends play out. I'm very excited about it.
I think 100 years from now, you're
Brian
just
Johnson ain't got nothing on me,
going to be like a can of Celsius.
Yeah, Brian Johnson ain't got nothing on me. I'm living forever, baby.
I believe it. All right, that does it for Morning Brief. Saz is up next on Yahoo Finance.